Um, yeah, just following up on the sort of comments around sort of the RDR objectives, and sometimes you may regret agreeing to do a certain topic. So I'm doing the very customer focused or consumer focused topic of sustaining fund manager profit post RDR, but again try and relate it back to the customer where possible. And first of all, I just want to talk about some of the RDR implications to fund managers. I think the first one, which really does impact fund managers, is obviously the separation between the costs of product and the cost of advice. So the ban on commission has a fundamental change in how fund managers work in the new landscape. The fact that advisors and clients will be on the same side of the table now will absolutely change the way fund managers engage with that marketplace. The other sort of major trend as a result of RDR was platform adoption. So platforms or fund supermarkets, their adoption is increasing largely as a result of the RDR. This has an implication to fund managers because it further removes them from the end customer, which has some significant impacts in terms of profitability and some of the commercial dynamics. We're also seeing a change in how financial advisors work as well in the marketplace. So, rather than being fund selectors, they're increasingly seeing their value in financial planning. So, again, the interactions fund managers would have typically had with financial advisors it's now fundamentally changing. So what does this mean to profitability? Well, if you look across the asset management industry today, costs are increasingly challenging to try and reduce. So most fund managers, if you look across the UK today, most have outsourced their core administrative functions, whether that's transfer agency or fund accounting. Talent in this marketplace for active fund managers is incredibly difficult to acquire, develop and retain as well. And actually the regulatory burden, so I don't need to tell anyone in this room that the regulatory burden, whether it's from the RDR, whether it's through the wave of European regulation that's coming down the line, that burden is not going to change over the near term. So actually, ultimately, for asset managers, it's all around scale, differentiation, and their strength of distribution, which will be key to sustaining profitability. I thought I'd talk through some of the trends that we're starting to see in the marketplace. These numbers are actually slightly out of date. They're actually 6 years out of date, but the actual trends are absolutely relevant. So for traditional asset managers, what we've seen over the last few years is a polarisation between different types of products. So those products that are really starting to gather scale are clearly the core sort of market tracking or index products, whether that's for ETFs, whether that's for index funds. We've also seen an explosion in some of those alternative strategies. That means for a traditional asset manager, that landscape is fundamentally different. And the RDR will absolutely act as a further catalyst to that trend overall. What does that mean in terms of sales for asset managers? This graph shows you European or cumulative European net sales over the last 6 years. Essentially, if you're a traditional asset manager, whether that was in equities, fixed income, money market, actually the last 6 years have been incredibly difficult for asset managers. And pretty much all those traditional asset classes have actually returned cumulatively net no sales over that time period. The two asset classes that really have generated net flows, mixed assets, so those sort of solution products, and what a farmer would call other, so some of those alternative asset classes. And again, that is a major trend that asset managers are having to react to in one way or another. The other thing about the RDR is it changed the buying habits of fund buyers and financial advisors. So this shows some research that Funds Network did last year, which just shows, again, the trend of how financial advisors are increasingly seeing their core competencies. So less and less are seeing fund selection or fund picking as part and parcel of what they do as a business. More and more are now looking to outsource decision-making to whether it's a discretionary manager or using things such as model portfolios. We've actually just rerun this survey, and the trend is absolutely going in that direction. So we do see more and more financial advisors using techniques and tools such as model portfolios or outsourcing that completely to third parties. Again, has a pretty major implication in terms of how fund managers engage with financial advisors. The adoption of platforms has, again, a major impact. So the more platforms are adopted, the further away the fund manager becomes from the end customer. And again, has a big impact in how fund managers work. The more intermediated those businesses are, the less control they have over distribution. One of the major impacts of that is around persistency of assets. So the closer you get to the customer, the more you can control and actually reduce or increase persistency. So if you look across the typical fund manager business, if they hold those assets directly with a customer, typically the asset life would be about 8 years. If you actually look across fund of funds, it can go all the way down to 2 years. So that turnover of assets is a real impact in terms of managing profitability. And if you actually look at the IMA sales at the moment, the level of gross sales achieved for that marketplace versus net sales, that gap is widening all the time, and that's just showing the increase in turnover of assets in that marketplace. If RDR forces more financial advisors into a more institutional-like style of management, that increase in turnover is going to, again, have a major impact in how fund managers operate and ultimately how fund managers obviously return profitability. So what we're seeing is the distribution market moving from left to right. Increasingly, we're now starting to see providers react to that and actually try and go more and more directly to the customer or into the financial advisory market. Obviously, clearly, I couldn't talk about the RDR and asset managers without talking about price. So clearly, the impact of the RDR will see the removal of commission from fund management pricing. We also are seeing a direction of travel where platforms are increasingly being forced to unbundle. Clearly, we're still awaiting the latest FSA consultation paper, but the likelihood is that we are going to see some pressure on platforms no longer being able to be remunerated by fund managers. What that is going to do is going to reduce the cost at which fund managers put products to market. I thought I'd use quite a simple example here, which is using the average weighted fees across funds network. So if you actually look at the current pricing across funds network, it's about 160 basis points, including the fee to the platform, including the fee to the advisor. If you actually remove all that commission from those products, it comes down to about 113 basis points. And actually, if you remove all the fees, including what you pay the platform, it comes to about 90 basis points. The interesting thing here is there's always a lot of comparisons between things such as the US market. People saying, actually, the US market's so much cheaper than the UK. Actually, on a like-for-like basis, which is that middle column, so net of commission, so that would include things such as 12B1 fees. Actually, the US market comes in at about 118 basis points. So you can argue, actually, the UK is relatively competitive on a like-for-like basis. Clearly, the big question is, though, is post-RDR, what ends up happening to the total costs? So simply fund managers reducing the cost of distribution, but then the distribution elements being added back on really has no benefit for the consumer at all. One of the things that we're concerned about is we see the emergence of what we've called Ryanair pricing. So where actually it's very difficult for customers to see the total end cost that they're paying. My legal team have actually asked me to point out there are other discount airlines available. So we don't just call it Ryanair pricing, low-cost airline pricing, apparently. So what does that mean sort of post-RDR? Well, if you look at the total cost of ownership, and maybe look at a passive fund first of all, a developed market index product, you're paying probably 15, 25, maybe 30 basis points. You then have to add the cost of a platform on, which is typically 25 basis points, sometimes more. And let's say the advisor fee is 50 basis points. So the total cost of ownership in that case for the customer would be around about 100 basis points in totality. Then look at what the active funds, and a typical active fund today, an AMC would be around about 75 basis points, platform 25, the advisor 50 basis points. That actually has some quite interesting dynamics. So we started off talking about the impact that passive has on the active fund management, but actually now on a like-for-like basis, post-RDR, we're actually talking about a 50 basis points differential potentially for an active fund versus passive fund. So a passive fund with all those costs laid in is going to underperform the index because you're having to pay for the cost of advice, the cost of the platform. In a post-RDR world, actually, you could only be paying 50 basis points different for an active fund. So actually, some of the impacts that the passive industry may have on the active fund industry may be less so. However, the big question is what happens if the cost of advice goes up? So let's say it's not 50 basis points, it's 100 basis points. What happens to fund managers as a result? Do we see further squeeze on fund managers? Does the platform end up getting squeezed? Maybe both get squeezed and actually margins actually get pressed on both sides. Maybe the advisor is forced to charge less, or ultimately, maybe the customer ends up paying more. And that's really is the big risk that we see with the RDR at the moment. At the moment, the likelihood that we see is, in a lot of cases, the customer is paying more, which is a really bad outcome for the RDR, and an unintended consequence. So in terms of fund managers, we see four emerging themes in terms of how fund managers will operate in the post-RDR world. One will be those who manage as pure beta, so obviously products that track the index. A second segment where it's really core or index plus performance. We then see, obviously, more and more focus on delivering true unconstrained performance or high alpha performance. The last theme we see is one that's exploded recently, which is around around solution products. So those products that deliver outcomes. And we feel that's an area which will grow and grow and grow. In terms of margin impact, well, clearly, if all you're delivering is beta or index performance, that is going to see even more squeeze than it does today. And clearly, the source of competition there is around scale and price. Where it's core or index plus performance, again, that's an area for the asset management industry where we see most margin impact overall, and ultimately that game is going to be around scale and price. High alpha is the interesting one. So those fund managers who can absolutely deliver high alpha or unconstrained performance, that is where actually there is a lot of ability to actually generate good profits in the industry overall. The solutions market, actually we probably see relatively static margin impact overall. And in those last two, it's all about products, it's all about capability, and it's all about differentiation in product. The implication to fund managers, though, is that these solution products, or running a solution business, is distinctly different from running a traditional asset manager. So traditional asset manager, competing in those major asset classes, it is all about performance history. It's all about having the right asset class at the right time, and clearly it's around the commercial terms you're willing to do that at. A solution provider is absolutely needing to be focused on customer outcomes and alignment to customer needs. It's all absolutely critical that they have a good distribution footprint and brand quality, and especially around brand promise around future performance, is absolutely critical to success overall. So clearly, in terms of concluding, the RDR will provide significant challenges to fund management profitability, and cost control is an area, but it's likely to be the one that actually sustains profitability in the long term. We do believe that providers will increasingly look to control the value chain, to improve persistency and control of distribution. So we are going to see more providers go direct and attempt to own platform and other distributors. We are going to likely see more product differentiation in the marketplace, especially around high alpha and solution products. And that explosion in what I would call the solution product range is going to become a major theme within asset managers, and we're already seeing that today. In the long term or in the medium term, you'd argue that there's definitely going to be consolidation in the marketplace, especially around those products that rely on scaled for success. So whether that's in the index or index plus solutions spaces, that is absolutely going to be some consolidation in that marketplace. In terms of I guess, sort of final message, the real impact on fund managers in terms of profitability is going to be where fund managers don't add value. So price is only ever an issue where in the absence of value, and that is going to be the critical issue for fund managers post-RDR. Thank you.